Well, welcome everyone to another Security Token Prime webinar. This week we have a lot of events going on, but today specifically is called the TradFi DeFi Hybrid. We're joined by Sid Powell from Maple, Asad Khan from Centrifuge, and we have Timo from Swarm. How's everyone doing today?
Great. Thanks for having us, Jason.
Thanks for having us.
Thanks for having me.
Absolutely, absolutely. So as people trickle in, why don't we start with some quick intros, just so people get to know you guys a little bit more, maybe a quick overview on what each of your companies does, and then we'll dive into the topic.
Sure, I can start. So I'm Sid. I'm the CEO and co-founder of Maple Finance. So you can think of us as an institutional lender on chain. So we launched about 3 years ago. Since then, we've done about 3.2 billion in loans, but a lot of what we've been doing early on was lending to market makers. Since then, we've evolved to doing tokenization of real-world assets, so like T-bills, other financial assets where we effectively have borrowers who lend again, who take out loans against them on chain. I think a big focus for us this year is how do we bring in institutional participants in on-chain capital markets.
Fantastic. Thank you. Asad, how about yourself?
Yeah, no, I love it. It's awesome to have everyone on here. Thanks for having me on as well, Jason. My name is Asad. I do all things biz dev and DeFi at Centrifuge. For those that don't know Centrifuge, we were the first real-world asset protocol to bring assets on chain. We work pretty closely with big and significant DeFi protocols in the industry, such as MakerDAO, Aave, most recently Frax. We really believe in the idea of using blockchain technology to really ultimately bring the full, portfolio and full credit market on chain and create cost efficiencies using technology. And, like Sid said, I think the world is moving on to kind of bringing on the next best and brightest of the credit markets. And that is like the world of institutions. And so excited to have this conversation with everybody.
All right, cool. Thanks for joining us. And Timo.
Yeah, Timo alias co-founder of Swarm. So we are an RWA company. We're regulated out of Europe, basically working on issuance and redemption of RWA assets, specifically known for publicly traded stocks and bond ETFs. But we also built a bunch of DeFi apps, such as a decentralized OTC protocol, which is both existing in a permissioned and a non-permissioned version. And then we also have a bunch of AMM pools where you can trade RWAs as well. So we do both like issuance, redemption, and liquidity. Yeah, that's us.
Fantastic. Awesome. Well, thank you, everyone. For the audience, make sure that, take notes. Make sure you can, feel free to ask questions in the meeting chat, and we'll get to them as we go along throughout the process here. But make sure that, you pay attention, keep an eye out. These guys are doing some really fun stuff. So without further ado, today's topics, we're going to be talking about lending and borrowing. We'll be talking about cash management, treasuries, institutional use cases, and the like. So starting with the lending and borrowing side, maybe we can start high level. What are some of the challenges presented in the lending and borrowing space in traditional capital markets, and how does blockchain help address them?
I'd love to jump in, just go there.
You go for it first, Asad.
Yeah, I think you'll hear probably a lot of the same themes here, because I think there's a lot of problems and there's a lot of opportunities to fix and create and add value in the space. The place I'd start is really that traditional kind of Web2 databases and Web2 businesses are built on siloed information, having to share data resources manually and kind of constantly reconcile and link between each other in a really truly outdated fashions. And with a blockchain, when you move to this like highly connected, highly automated system, you have this ability to start opening up credit markets and things in ways that I think are really interesting and exciting. For me, what that really looks like is I think the world of DeFi has proven what you can do when you have assets that are on chain, cash that's on chain. And so for me, it's looking at credit markets, looking wherever credit markets trade over the phone or trade with manual bilateral processes. You can really create significant value recreating the structures of DeFi in an on-chain data format, but built for true debt and credit instruments.
Yeah. I think, so the way I saw it was like when we started like using these borrow and lend applications that were using digital assets natively only. They were kind of really cool and obviously automated and super efficient, but we always saw that there was like the lack of non-correlated assets. So the whole kind of model, if you've been in it for a while, you kind of saw some of those like breakdowns happening both on maker level as well as some other platforms where, even the liquidations on Ethereum didn't really work out as it was intended to. So I think, both like a network congestion issue as well as kind of a correlated asset issue has been things that we've had to live through. And I think that things have kind of matured enough now so that, once we bring on RWAs as well into the mix, then things get more kind of distributed by nature of the assets as well as the correlation of the assets, which means that borrow and lend can really start functioning properly on a fully automated level. And, the need for underwriting and other kind of functions that are, let's call it TradFi related, are needed less and less.
I think two other things that stand out as issues with, call it the old style of lending and borrowing in traditional finance would be transparency. So I think it's very opaque. And this is one of the key things that's solved by doing this on chain, is that you can see when a loan is being taken out, when a party is paying it back, and what's happening with the money in the meantime, as well as any collateral. And, this is one of the things that we all believe in, which is, tokenization of assets. That makes them terrific collateral. The other second point is it's so costly to set up a lending business or a banking business in traditional finance. And that's fixed or addressed when it comes to the blockchain by the fact that we can all custody our own money. So that's what a blockchain wallet gives you. And so when we can easily send money to lending or borrowing customers, and program how that money flows, it just, it drops the cost of running a lending business by about 100x, at scale.
I'm glad that you bring up transparency, Sid. I think there's something that you kind of referenced, I think, in one of your previous webinars at Maple, which was Voyager, Three Arrows Capital, Celsius, stuff that happened. So can you give us a little bit of background on to what happened in those situations and kind of how blockchain is helping solve for those, including the transparency that people may be able to find on Maple's platform?
Yeah, so what happened with those three is kind of complex. They each went through separate issues. So 3AC was a hedge fund that borrowed a lot of money from folks, including Voyager, and then lost it because they took directional bets that went against them. One of the key issues from Voyager's perspective, who was one of their largest lenders, was that they couldn't see what was happening with the funds. And so once they gave the loan to them, it was really like going into a black box. They didn't know, how solvent 3AC was at various points in time, and that was the key issue. So the transparency of being able to monitor the health of the people that you're lending to is one of the most important things that's addressed by doing this on chain. And then Celsius was a bit of a different situation, wherein their lending and borrowing actually performed reasonably well. It was the other strategies they were doing. So DeFi, which again comes back to this idea of transparency. When you gave them your funds, you didn't know what was happening to them. And on the back end, when people looked afterwards, they could see that they were doing a lot of risky DeFi strategies and yield farming, and that risk wasn't known to people ahead of time as they were putting their funds in there. And so I think, again, something that's addressed by doing this on chain. You always know what's happening with the money. You can see where the flows are going, and you can see if the party is going to be able to repay you at the end of the day.
Yeah, and I think also like those centralized, which, both Voyager as well as Celsius were platforms. I mean, they basically got into like call it, yield war, a price war, whatever, however you want to express it. So they were like, one party was paying, 5.9% on Bitcoin deposits, and all of a sudden, like, okay, next guy is doing 6.9%, and then somebody's doing 7.9%, and that's when things started breaking. And then, it was almost like a question of like, how much have you deployed into Anchor, Terra, Luna exactly? And because they were paying 20% at the time, and then like, what is your like risk level that you're willing to absorb within that model? And then, so I think that was part of the. According to my understanding anyway, like the 3AC model as well, was that, maybe they were overexposed in a bunch of different places, including, Terra Luna as well. So I think like in the end, it was just like super risky bets being taken on the premise that, you had to pay out a certain yield to depositors on those platforms. And that was the name of the game. And then obviously, it worked until it didn't, and it all blew up. So I think, just comparing that to, compound. And so when I said that there was a deficiency, in terms of like maker liquidations on Ethereum in, I think, 2020 or something, that's like nothing compared to what happened to 3AC, Terra Luna, and Voyager and Celsius, obviously. Those were like minuscule losses comparatively. So DeFi held up really well throughout the mayhem. And, I think there's a very good reason for that, why that was the case.
Yeah, and I think building on that too, like, at a high level, Timo was mentioning it, there's really just a lot of unsustainability that was built into like kind of the lending and borrowing practices and the core of that business. And Sid was also mentioning kind of the way that 3AC and Celsius were operating, especially 3AC. You had a collateral problem at the heart of it. You didn't have access to quality collateral for posting a margin when you were running some of those more exotic trades and executing some of those parts of the balance sheet that were, say, a little risk seeking, right? Which they're entitled to. But when things start getting tight, volatility starts kind of unwinding in the market, and you have things like anchors starting to fall apart, and you combine that with poor quality collateral, that starts putting pressure on your margin, that starts putting pressure on your book and all your counterparties, and all of a sudden the whole industry is toxic and upside down. I think that's really a lot of what I think the real world asset industry is doing as well, right? You mentioned cash management at the beginning of this, but that's really where you start to get to having better collateral on chain that can kind of really sit in as a better cash substitute and hopefully dampen some of that volatility you would see and more traditionally.
I also think Timo touched on a good point, which is the market structure of where we were in 2022 was that everyone was getting mark to market on the origination. So you could do successively higher VC valuations if your loan originations went up. And so that inevitably drives a decline in credit quality, which is what we saw in the books of, Voyager, Celsius, and the other centralized lenders there. Really? And that happens every cycle. So you'd probably expect it to happen next cycle as well.
Really interesting point you guys made there. So, obviously the transparency part brings a lot to the table for both the lender and the borrower on different, aspects there. But speaking of kind of like these loans here and the fact that they're on chain, what kind of unique or traditional assets do you guys see backing these? Obviously, we want institutions to start partaking a little bit more, or at least explore this world. So are there any institutional level, assets that are backing some of these loans that maybe were a little harder to do on a traditional only environment?
The most obvious one is U.S. Treasury assets. It's hard to get more institutional quality than the debt from the U.S. Treasury. That's the easy answer. My general take is that I think actually what's really exciting about today is and what makes me really bullish on the next kind of cycle is that you actually have quite a range of diversity of assets that are being brought on chain under the scope of real world assets. You have sovereign debt. You also have private credit, which was kind of what was here in the beginning. But you're starting to see investment grade credits originated on chain. You're starting to see things like commercial mortgage backed securities, for example. You're getting a lot. You're starting to climb the curve in terms of quality of issuer, which I think is the most important aspect of it, and also quality of structure. I think as the whole space has been maturing over the last 12 months, you've seen kind of just improvements on what the supply side of the market looks like.
Well, just say, it's, like you kind of started alluding to, Asad, we've seen invoices, letters of credit, real estate, revenue-based financing all become some of those assets that start being kind of the backers of some loans. So, what does that process look like? If someone wants to work with you guys and kind of do, some kind of pool for these assets, what's the process? How hands are you with this process? Can you just explain a little bit more of how people go about it on your platforms?
Happy to, Jason. The way Centrifuge works is really we're like a securitization protocol. So we have this kind of on-chain engine that's run through smart contracts that exist on-chain that allows issuers to come to the table. We have this concept of asset level NFTs where you can actually mint tokenized representations of your underlying loan book, whether it's financial collateral, whether it's loan agreements, whatever kind of underlies the portfolio itself. That gets issued into an on-chain portfolio, and on-chain portfolio is then spinning out.
Guys, we just removed that person. Asad, thank you for the explanation there. Is there something that maybe we missed towards the end there?
Well,
sorry, no, go ahead, Timo. I'd love to have the other panelists speak as well.
Okay, well, glad you said no. I interrupted you. So, I think, the way we approach that is actually quite different because our model is based on basically bringing well understood assets on chain first and then building kind of the whole kind of lend borrow model on chain. So it's slightly different, I think, from Centrifuge. So the general idea is that, we kind of use existing DeFi platforms for both the lend and borrow side, but, with a new category of collateral. And that's basically the value of bringing, for example, public stocks on chain would be that they're really well understood assets. So if you bring Apple, Microsoft, MicroStrategy, NVIDIA, etc. on chain, then people know what things you're dealing with, but then also they kind of need to understand, what does that process look like? How do I know that the assets are there? And how can I kind of understand that this token actually represents the underlying? Once you're past that, which is kind of, what both Tether and Circle have gone through over the last few years, then, people can kind of trust that structure. And once they trust the structure, well, then you can start moving into building composability and applications on top of that, including lend borrow, which we think is an excellent use case for, why you would hold public stocks on chain. Because in the end, yes, maybe at some day, we will only have digitized wallets that would have all our assets. Today, that's not the case. So I think, just kind of showing some really compelling use cases and getting people there is really valuable right now. And once everybody's there, well, then, it's obviously all digital. And then it's we're not even going to talk about blockchain anymore, because it's, it'll be like email in whatever, 20 years ago. So I think that's where we're headed, but it's a long journey. And I think, showing some of these really compelling use cases that are not even possible in TradFi, I think that's really important, because that's what brings real value to users and investors.
And speaking of value, can you guys talk a little bit more about any insights from a savings perspective that maybe gets translated over to investors, with any products that are on your platforms? Or aside from savings, maybe any other streamlined processes that maybe just weren't possible beforehand.
I can kind of speak from the Centrifuge perspective, but you kind of get speakers back on stage. For us, we think there's significant cost savings on kind of what I would call the kind of manual fund operations side of the business. So there's a lot of benefits to be had on the secondary markets, trading transactions. For Centrifuge, though, we're focused kind of on primary market execution, on where funds kind of come and meet the on-chain capital markets. We think the benefits are really there, and the ability to streamline kind of the data flows and data processing that happens back there. Kind of integrating things like fund administrators, third-party audit reporters, and ultimately, we see a vision where there's actually asset level kind of services and value chains being brought on chain, whether it's data streams or underwriting and those kind of ideas. So that's where we see the cost savings, and that's kind of the we've estimated out to 25 bips, right, in terms of running a fund comparatively. And I think there's a lot more to do as we keep building out the product.
Yeah,
I was just going to.
Go ahead.
Go ahead, Timo. I was just going to say, I think where we find the cost savings is similar to what Asad said. It's in the back end middle office functions here. So keeping track of a portfolio. Most people in traditional finance are using spreadsheets, for lack of a better word, in how they track private credit and direct lending portfolios. And so having this all on chain and being able to manage it automatically saves a ton of cost. And then you also save a lot of time actually in being able to do the loans, because you can just send it directly to a party rather than having to go through a correspondent bank, where it might take weeks in traditional finance to do.
Very good, very good. All right, so I kind of want to move on to the cash management and treasury side of the conversation a little bit more. And this is maybe a rather high level question, but just to kind of get things started. How do cash management solutions, solve for crypto native investors looking to participate in traditional markets, and vice versa, any traditional or institutional investors to be a little bit more on chain, if you will?
Yeah, I think what we've seen is that, basically because we brought the treasury bond ETFs on chain through a public prospectus, that prospectus allowed us to offer those products to anyone on chain, basically, both retail as well as institution. I think that's kind of one of the dividers compared to some of the other initiatives that we've seen in the market, where, you can only offer certain types of products to certain audiences or investors, which is fine. If you go after institutional only, then it's not a problem. But if you're trying to build something that more provides a horizontal capability overall, then we thought that the idea that, you could basically offer it to anyone. When I say anyone, there are obviously still the restrictions with regards to OFAC and right now also US and Canada, unfortunately, but it is what it is. And so we thought that that was important just to be able to kind of create that yield on chain for everyone. So that was kind of how we built it. And then, from there, now we can basically start distributing those products to the places where we see opportunity that are not covered by other projects as well. I mean, there's plenty of opportunity out there. So it's just a matter of like getting in front of the right people with the right product and then, connect the dots basically.
Yeah, can you guys go into maybe more specifically now into the use cases, such as the types of consumers or customers that may be interested in cash management solutions, such as like corporate treasuries versus individuals versus funds?
Corporate treasuries is a big one. So there are a lot of groups, to crypto startups who might have raised capital in the last year or two, and some of them were finding recently that they were getting debanked. And so there's a big use case in just holding your corporate treasury in stable coins. And then you'd be interested in these cash management type products where you can get yield that's ultimately backed by T-bills. And so that's been a big use case for them. For DAOs as well, because typically they would struggle to open banking relationships. And then what we found was high net worths liked cash management as kind of a staging area before they would go into higher risk, higher return type investments or allocations. So whether that's making an LP commitment, buying the market or buying the dip, or trying to do an airdrop farm or something like that. But those are the types of strategies they're looking to go into in 2024 as people go a little bit more risk on. But the cash management was like a great type of product for people in that kind of interim stage when they just want to park for a good yield.
Yeah, the summary of like all of that, I think, is that the conversion from offering fiat to crypto is super painful. Even if it's like completely secure and don't have to worry about debanking, which is a significant risk. There's just flat out fees and pain, right? I think another part of it too is that as the market develops on the DeFi side, you have a lot of what I like to think of as like excess capital, and this is an excess risk-seeking capital. This is excess capital that wants to be protected, returned, and kind of preserved over the long run of the life of a protocol, a company, or a team, or an organization. So that's kind of the corporate treasury experience there. But I think it goes a little bit deeper. That just the space is maturing with a lot more longer horizons being built into kind of DeFi participants, and that's who I think is mostly reacting to the cash management trend.
Very well. Any thoughts on cash management, Timo, from your end?
Yeah, I think, what we saw was like, when Tether and Circle started posting, certainly Tether started posting their financials, people were kind of really starting to look for like solutions to, partake in that yield generation that they're seeing, right? So I think, obviously that kind of brought the whole, so if they're buying treasury bonds and getting this yield, why aren't we doing the same thing? And so just introducing those products on chain just kind of provides that ability. And then so you can call them like, whatever you want, tokenized treasury bonds or yield bearing stable coins or whatever you want. It's just like a natural evolution that we're seeing and we're working on just to kind of augment what is already there in the non-yielding stablecoin space.
Is there a certain point with interest rates changing that it doesn't make sense to go on chain and have on chain treasuries, or is it always a plus? And how do you guys feel about that?
I mean, look, I was actually just before this call, I was just kind of going through where like Aave and Compound are on various kind of stables and stable deposits. This is a very kind of fluctuating environment, right? Like, last year, treasury bonds just kind of took over yield-wise from stables. And now when we're seeing kind of the market starting to move again, well, now you're getting like literally 12 to 13% on Compound and Aave for USDC deposits. So like, this is, but then again, like what's your risk exposure to that? And how do you view like smart contract risk and other security risks that, you might have to deal with? And so I think, yes, there's always the higher yield somewhere. And I think right now the whole thing has reversed from last year, but still, I mean, I think we just need to have it all on chain. And then you just kind of figure out what your allocation strategy looks like.
Yeah. Honestly, I think there is like the world is more different than I think it will be before let's say the previous hiking cycle. Like one, are rates going to go back to zero? That's a big question. Everyone wants to play the bond trader game, but like the reality is there's going to be a path that gets followed from here to there. And so I think there's going to be a lot of really interesting stuff that's going to happen in terms of different assets that will come on chain. That'll be interesting. And second, you mentioned it earlier, but the reality of like on-chain collateral and on-chain lending being integrated with real assets, that's happening today as well. So that will kind of change the nature of the business for on-chain lenders and on-chain providers. And then ultimately, I think at the end of the day, that switching to off-chain kind of assets will slowly stop becoming the de facto standard, and you can get kind of the equivalent risk-adjusted equivalent of real assets on chain in ways that I think will make people happy to stay there and keep it there. Macro environments change. I think businesses and markets react, but it will be more interesting, I think, than just going back to what it was before.
Yeah, no, we definitely heard great feedback from people, obviously enjoying the ability to stay on chains, reap some of that yield, and not have to on-ramp, off-ramp every time they want to make an investment or liquidate. So that makes sense to me. That being said, there are a lot of treasuries that we have covered come on chain from multiple service providers around the world. We've done this on the Security Token Show multiple times, multiple weeks in a row now. So is there a point where it becomes too saturated? Do you guys have any opinions on the amount of offerings that are available? And how can people kind of understand what's best for them?
It's been pretty flat over January. So I'd say you've kind of seen at least a local maximum in terms of the plateau. Like I think if you look at RWA.xyz, it probably sits around 830 or 850 mil. But there's now probably more than a dozen different providers that you can choose from. And so I think competition's good, but it does reflect the fact that treasuries are considered a very safe asset. So it was kind of the first one that a number of us, who are doing things in that space wanted to offer. But it's a huge asset. Overall, will it continue to grow? Probably, because it's such a huge asset class. So we're all still a drop in the ocean in terms of how many T-bills there are outstanding. And I think as more folks come on chain and they just want to park their stablecoins in the most liquid thing available that's producing the lowest risk yield, that will naturally be T-bills. So I think you'll continue to see it grow, but I do think we kind of hit at least a local plateau versus the kind of the meteoric growth that was occurring throughout the middle of 2023.
Yeah, from my perspective too, I think that there's you will start to see that not only is there enough room, I think, for all of these protocols to be providing kind of opportunities for their individual segments of the market. I think you'll see that protocols will differentiate by adding, I think, more value-add services. So with Centrifuge, we launched Centrifuge Prime, which was a managed services offering kind of targeting DeFi native organizations and customers who really have the most challenge when it comes to accessing real world assets. And it's like expertise we were kind of uniquely able to provide. Like that's what we think is an example of, I think, there's plenty of other examples in the market as well of that kind of happening. I think that you'll see more of that, and that will start to be built out in technical areas and commercial areas and business areas as well.
All righty. Well, we are, about halfway through or maybe a little more. So, I think we've stabilized the audience here a little bit. So audience members, if you have any questions, just drop them in the chat and we will get to them as soon as possible. In the meantime, do you guys have any insights based on like the providers or clients that you guys are working with as to if you have a portfolio, how much of that is allocated towards on-chain yield generating assets? Any particular flows to certain asset class subsets over others?
I think
over. You go, Timo.
Yes, there's a couple of things that we want to solve for. One underserved group that hasn't really been involved yet that I think will be gradually more and more involved this year is it's basically like people with large equity portfolios that want to get into crypto, but they don't think that necessarily the Bitcoin ETF is the only instrument that they're interested in, but they actually want to start building strategies and a portfolio there. And then, so we see that like providing the ability to bring, part of an equity portfolio on chain and then using that as collateral to kind of free up cash to invest in crypto without selling your kind of, call it main holdings, is like one use case that we've identified that we're kind of solving for right now. And it's just an underserved group that hasn't really been like that active before, that we think, given that everything is becoming more like mainstream this year, I think by and large through the ETF approvals, I think that's a huge factor when you're hearing all these large institutions kind of talk about crypto in a way that, we've never heard before, really. I think that's a really positive sign. And it also kind of allows for people to start exploring these opportunities increasingly without actually kind of necessarily, like you said, reallocating or changing their portfolio strategy completely, but rather just kind of, starting to dip their toes by just kind of using the collateral that they already have.
Makes sense to me. Sid, Asad, any opinions there or any insights from your clients?
Go ahead, Sid. Oh, the dreaded mute. Yeah. No, yeah, I think Timo covered quite a bit of it. Yeah. In terms of like the flows, the asset classes are picking up. It really depends on kind of the type of investor you're talking to, but definitely there's like that. The world has been pretty risk off universally, I think, and that's that represents what has been happening in the U.S. Treasury market coming on chain. I think you'll start to see people climbing out of that asset category. And I think as the world becomes more risk-seeking, and depending on what happens in the world of DeFi, I think you'll see like there will certainly be diversification will become kind of a common mandate, because ultimately, if everyone's doing treasury bills and rates are starting to normalize, that means there's a lot of other alpha to be had in the room, and people don't want to leave money on the table because you'll be losing out to your competitor in the lending and borrowing market.
We're already seeing a lot of interest pick up in kind of broader crypto lending again. So, market makers were big borrowers in the 2022 cycle, and they're starting to come back because retail interest in trading is picking up as Bitcoin and the broader, all crypto assets have been climbing recently. And so I think it's good. It's good for the overall space. Like lending and borrowing needs to function well if you're going to have good trading conditions and people being able to trade on exchanges without shortages of liquidity. So I think I view RWAs as kind of continuing in importance, but that it's think of that as like a linear line upwards, but then you have kind of regular crypto lending that kind of whipsaws around it. Like last year it was less important, this year it's getting more important, but whereas RWAs continue to follow a little bit more of a steady trend upwards. We're definitely seeing more risk-on behavior from folks. So people are coming out of our T-bill pool and they're going into buying the market or farming for airdrops or making LP commitments to funds.
I love it. Sid is bullish. That's what I'm hearing.
Yeah. Well, it means we've got to start to provide higher yielding opportunities to keep those folks interested. And ultimately, you just want to provide the types of products that your customers want. So when they want conservative options, we give more T-bills. When they want more risk-on options, we try and find things that'll pay out punchier yields, hopefully still with good collateral protection. So we're looking at things like we've been doing more BTC and ETH-backed lending. We're increasingly looking at doing like Sol-backed lending and some other altcoins. But ultimately, you got to have a few different products, otherwise your customers will go elsewhere.
Yeah, so I mean, look, going into the looking forward section of this conversation here, which is kind of what we're talking about now. You just mentioned, right? Bitcoin, crossed 50,000. People are starting to pay attention to the charts here. And so kind of bridging in with Katie's question, how will new economics on chain lead to greater capital efficiencies in the run up and during the next bull run as we, continue going up, whether from what exists currently or what you guys are planning to offer in the future?
There's a trend last year, or like now 2 years ago, right? When kind of the real world asset narrative started to pick up pace, facing kind of a downtrend in like the last cycle, where there was real interest from off-chain, quite large parties, kind of originators and capital institutional issuers, right? Asset issuers wanting to access kind of crypto native liquidity. So I think when you see things like Bitcoin kind of trending to like, new highs, and that does happen, you do end up having a lot more wealth created in the crypto ecosystem. You have a lot more of these businesses that we're seeing on chain start to get created again. Goes back to what I kind of said earlier. And I think you'll start to see a lot of interest for like, right now we have a capital problem, right? Everyone's kind of like looking for capital and hunting for who's got the money. I think as crypto native liquidity builds up, depending on the networks that are built with these protocols, you'll have a lot more interest going the other way, and that I think really will help kind of kickstart the other trend of real world assets continue to be relevant as well, right? So I think it's all bullish. I think it's all a good thing, and it makes the whole space more interesting.
Yeah, no, I agree with that. I think comparatively, obviously in a full risk on bull market, people will go for crypto rather than RWAs. So that's basically the gateway drug then for people to get into the ecosystem. Once they're in the ecosystem, and things turn, or like there's the inevitable whatever 30% correction. Then you have to start thinking again, and then it's like pretty convenient to have these other things on chain already, because then you can start actually being a bit more maybe smart or cautious, whatever you want to call it, around how to do things. So I think it's all good. I mean, we all kind of love a bull market. It's like super exciting and very kind of frustrating at times, but like it does bring in people, and it educates people for better or for worse, and then eventually the whole thing matures, and it's not it's not very different from .com. So, as you can see from my hair growth, I was around actually in Denver at that time as well. And so, it's just another horizontal, fantastic technology that's going global. And, it brings these cycles with it. And it's super exciting.
Really, really cool, guys. I mean, I know you guys are all doing some fantastic stuff, and we have some bullish views, but let's look at the other side of the coin here. What's the missing piece? What kind of infrastructure is kind of still needed to bring more capital markets on chain? I know we said, we're bullish. We're all seeing more growing on chain, but what's still missing to link capital markets over?
I think stable coins is a huge one. That's kind of the, think of that as like the oxygen that the space needs to grow. So if we're all doing lending and borrowing predominantly in stable coins. So if we don't have, like if the amount of lending activity you can do if there's only 1 billion stablecoin market cap is hugely constrained. We're at about 130, 140 billion, and I think we'd like to see that get closer to 1 trillion over the next as we hit the top of this next cycle. So that's probably the single most important thing. And then the other one is good on and off ramps. So I think most of us are using Coinbase Prime or some variation of that at the moment. We've probably spoken to about 10, 12 different on and off ramp providers, and it's really hard to find ones who can do large transaction sizes or do it reliably or are low counterparty risk. And so I know there are more coming to market and getting funded, and that's also super important because that's how you ultimately get on chain. And then the other one I'd just add is Lindy effect. So the longer, the more years we go without a multi-billion-dollar fraud, touch wood, we've just passed 1 year since one, but the more years we pass without a multi-billion-dollar fraud, the more comfortable institutions are, putting their reputations on the line and suggesting, or people within institutions suggesting that they should do something on chain.
1 year since workplace injury, right? That's like,
yeah.
Stablecoins, I think, is a great call out. Just one thing I'll add is I think it's like the work that Swarm is doing is really good, but I think we need more players that are engaging with that type of concept, and they need to be licensed, regulated themselves. They need to come into the market with a little more maturity, a little more sophistication than we saw in the last cycle. And I think that will happen. I think that's kind of what we're all building for. Those are the guys we're talking to in the market. But new funds, new intermediaries, new lenders who are coming in, kind of willing to build on chain, use the primitives that we've established. I think that's what will be kind of the key that's missing, that will ultimately come, but will take some time.
Yeah, and I think on the retail side of that, I would add basically banking and usability, obviously. So I think on the banking side, it's still very problematic that, if you're trying to transfer something to Kraken or even Coinbase, then, you basically, your bank says you can't do that transaction. We don't support transfers to those institutions or to those companies. So there's still a lot of friction in the, in that kind of bridging, fiat and crypto. So I think that's still something to solve for. And then the other thing is just like, I have friends in tech that are still like asking me to help them with some of their like wallet related stuff. It's just like, and there's a lot of improvement there. And I think on the high end of usability, if you want to call something like a Coinbase that, for example, then maybe the cost structure isn't ideal. So then if you want to optimize on that, then you have to go to something that's a little bit more difficult to use. So I think the whole thing kind of needs to converge to something that's like super user-friendly, obviously, as well as cost efficient. And that also goes for the fiat gateways, because it's just like cost prohibitive today to use a lot of the fiat gateways to get, you know, cash on chain, because, you know, if it's 4%, it doesn't make sense in most cases, actually.
Oh, I'm glad you guys touched on both the institutional and the retail perspectives here. So, you know, kind of going on that and what insights you guys have seen based on users that you have participating on your platforms. Are you seeing more institutional players willing to act as the issuers or the buyers on your platforms? Or is it a little bit more, you know, primarily retail driven on the demand side and smaller corporations on the issuer side? You know, what kind of trends are you guys seeing from the user perspective?
Well, we're seeing on the issuance side, we're seeing a lot of large institutions that want to tokenize things because they understood that, you know, there's enough people saying that that's a good thing, and they started to educate themselves around what the benefits are, and they are really serious about doing it at scale. That takes time, so it's not as visible as some of the other stuff that we're doing, but it's like, you know, this slow-moving flywheel that, you know, once those things come on chain and it actually works, and it's like it's been structured correctly and brought on chain correctly, it's massive, but that takes quite a lot of time. But we have a lot of inbound across various asset classes.
Well, we want to make
We're
sure
seeing mostly high net worths in terms of using the pools. Starting to see more family offices, and then not too many funds, not too many, and you know, zero pensions and endowments. So I think that comes later. They would be expected to be later adopters. But if you look at issuers versus buyers, so it's similar to Timo said. It's mostly issuers, and I think this is one of the problems is we do need more people who are willing to be kind of consumers or investors or lenders in the assets. But either way, people who have capital who actually want the yield or want the returns from the reward assets. At the moment, it's mostly sellers kind of in the market looking for buyers.
Yeah, everyone wants to tokenize their stuff and bring it on chain in a world where, you know, capital is constrained. Yeah. But I do think on the investor side, you know, the one thing I'll add that I didn't hear like panelists, you know, say was that I think there's like a new crop of investment platforms that's kind of coming into vogue today, and I call them investment platforms because really they kind of take up and look like a number of different kind of business structures and business models. They can be set up like a fund. They can be set up like kind of like a trading advisory shop or trading infrastructure and execution shop. And essentially what they're doing is they're kind of accessing new capital markets where there are lenders who have, you know, interest in coming on chain or have already done so and are now kind of looking at coming in more effectively to, like, you know, operationalize or scale their kind of investment capital. And I think that is like really where I think the most exciting like opportunity lies in this next cycle. A lot of stuff happening in Asia and like the Middle East and kind of even Europe in some ways. Those are, I think, where like the most interesting set of like investors are coming from, you know, along with the stuff that Timo said as well.
Awesome. Well, we are coming up on time soon. Another question in the chat that we have here from Yonks. We are wanting to begin conversations with DeFi protocols seeking capital to tokenize electric vehicle loans. Are you guys aware of any players that are doing this yet, tokenizing vehicle loans?
I've seen home loans. I haven't seen vehicle loans yet, but I'm sure it's not far off. It's a massive asset class in traditional finance, so I wouldn't be surprised if there's somebody out there working on it. But happy to keep an eye out for Jason.
Yeah, Jason, you know, if you're interested in building a fund, tokenize a fund of tokenized vehicle loans, you know, Centrifuge would love to talk to you. So that's kind of, I think, what we see as being, again, liquid assets at trade. That is going to be fund shares rather than necessarily individual loans. And I think that's where we kind of have a sweet spot for what our technology can offer.
There you go. So Jason, go ahead and reach out to Asad, see if there's something to be done there. Alrighty, so for the panel, we've covered a lot today, and so we will be editing this video up to be a little bit more smooth for everyone to consume afterwards. But before we close it out, are there any topics or any things that we didn't cover yet that you guys think is essential to cover and we should probably talk about for now?
Yeah, I alluded to in my last kind of answer about like interesting investors that are coming on like other parts of the capital markets. I think there's a lot happening outside of the U.S. and that is really, I think, super relevant. There's a lot of like regulatory and interesting. I mean, Swarm is a great example of this, actually, right? Being based in Europe, but I think there's a whole angle where new jurisdictions, which traditionally would have gone to like Web2 kind of traditional rails to find their like opportunities, are really tempted to look at the improvements that are enabled by Web3, and we're in a much more mature place to really take and use that capital. So I would say that just repeating that kind of idea, I think that's really one of the most interesting trends that people will continue to speak more about.
Fantastic. Sid, Timo, any closing thoughts?
Yeah, no, I think just kind of continuing on that theme. I think it's really about striking the balance there between like usability and compliance, so that you don't kind of overbuild out of the gate in one direction, because neither of them are going to work long term. So I think what we're trying to do is kind of build that balanced view of like, okay, so where do we need what level of compliance exactly for this type of transaction or function or service, and then kind of. That's why, one part that we built was this like fully open, decentralized OTC contract, which basically solves the problem of like, if I'm going to swap something with you, how do I trust you, and who sends the first transaction, and then how large is that transaction? If you have a smart contract do that for you, then as long as you tested out the smart contract, you don't have to trust the counterparty. You just need to know that the smart contract is going to handle the atomic transaction. But having said that, you can also impose certain requirements on that counterparty saying, hey, I want you to not be from, this and that country, or I want you to have the following characteristics, for example. And once you're qualified for that, we can kind of perform a transaction with each other. So I think that's the flexibility and kind of the efficiency that's being provided by smart contracts. And we're just trying to build around that so that it becomes like as usable as possible while still being kind of compliant and kind of useful for the participants that require that level of protection, which not everybody does. So.
To that. And Sid, any thoughts?
No, I just echoing my earlier sentiments. So I think this year is going to be a really big year for lending. We're already seeing the market kind of get more bullish. And so everything that everyone who's on this panel today is doing is going to be super important for enabling that. If anyone's interested in learning more, we're at maple.finance, and you can always reach out to me on Twitter, so @SyrupSid, and I'm sure Asad and Timo are also happy to take any questions that people have if they want to reach out on Twitter or online.
Yeah, absolutely.
Perfect. Awesome. Well, thank you three for your time, sharing your insights with our audience here. Lots of stuff that we covered as mentioned earlier. So we'll definitely be circulating the recording around. Appreciate it. Thank you so much. And for the audience, we do have more events coming up later this week. So make sure you check out the upcoming events section of Security Token Prime, and keep an eye out every Monday morning for the weekly STP Insights newsletter. So with that, thank you so much. Have a great rest of your days and great happy tokenizing.
Thanks everybody.
Guys.
What's up, guys?